Whew. All right, folks. Thanks to those who are able to attend today. As a reminder, if you have any questions, you can feel free to ask them during the webinar here. I'll do my best to answer every question, either in the middle of the webinar or at the end, depending upon how it goes with the flow of the presentation. And I hope you all survived the craziness of the day. And I know you're all now excited about trading gold, silver, and oil. So today for the Option Hotline webinar, we're going to be talking about how to profit trading core commodities. I am Keith Harwood, and we'll get straight into it after we do the disclosures here. All right, so my lawyers make me always write this and put it up, so make sure you take a chance to read it. The key here is all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. There's a bunch more there. I'll give you a moment to scroll through and read all the legalese. All right. Hopefully that gave you guys all long enough to run through that. And now we can get to the exciting stuff. So first me. So I've been trading options for a long while now. I started in 2005 in the pits of the SIBO. After graduating from Notre Dame with a focus on math and economics. So I've got a little bit of the analytical side there. After going through the subprime crisis, equity options market making became a little bit less exciting to me. And so I started looking for different sectors to trade. So I actually moved over to originally European fixed income. And then when quantitative easing came out, I moved to gold. So I started trading options on gold and silver using all of the nuances of options to try to trade with a directional bias without as much directional risk. So rather than buying and selling futures, I would put on complex option positions that were meant to trade around the distribution that the market was giving me. While I was doing that, I actually got my MBA from the University of Chicago, focused on analytic finance, econometrics and statistics, and entrepreneurship. And I used that to try to leverage this whole thing into working for a hedge fund. And at that fund, I initially traded exclusively precious metals and options on precious metals using that directional bias. Worked with them a lot on their technical trading. They taught me more about technicals. I taught them more about options. And so we used that for me to then structure a lot of their options, most of the options trades that they traded in the commodity space. So that got me to trading, obviously, gold and silver. We traded copper, we traded oil, we traded natural gas, we traded all the grains, soybeans, corn, wheat, we traded all the softs, sugar, coffee, cocoa. Basically, if it's in the commodity space, we traded it. And one of the things that I learned from this whole experience was number one, the technicals seem to trump all. And B, I can use my options knowledge and the leverage that I can create there for much better return profiles than one can in futures or an outright equity position, especially when we have a directional bias. So I left that commodity trading advisor, started up Trade Academy in 2017, started the partnership with Option Hotline when they launched this year. And that way I could bring my knowledge to the masses and work with all of you guys on ways to trade smarter and use the tool set that the market provides. Because that's the whole goal here, right? The market gives us many, many tools. Stocks are just one of them. ETFs are just one of them. But when we get into the options market, we get a lot of nuance and a lot of ways to trade these markets in a much more interesting way. So if I can combine a reliable signal with my expertise in options, I can create major leverage in the markets and really multiply my return potential. So that's what we're working on now. And today I'm going to talk to you guys about the commodity space. Now, before I even get into what we'll discuss today, I don't know how many of you were watching the crazy market action today. The market got absolutely destroyed And that creates these opportunities for things like diversification and correlations to be under consideration. We're going to talk about the benefits of diversification and the use of core commodities as I go through these slides. But I think today is another key example of some of the stuff I'm going to be talking about later. I'm going to talk to you about investing versus trading because that's crucial in the commodity space. What really moves these commodities, why I use options. And then at the end, I'm going to give you guys a special offer. So I want you guys to make sure you stay to the end, listen through the whole thing. There's a lot of information we're going to be getting into. If you want to get more information on some of the stuff we discussed today, double check for that Core Commodities course that you've already been given the offer on when you signed up for this webinar. That's going to give you that much more information. And then you can kind of continue through from that. But again, we're going to give you another offer after the end of the presentation. So just stay tuned, listen through the whole thing. There's going to be some stuff that you might say, oh, I've already heard it before, but I'm pretty sure you're all going to learn something new today. And we can hopefully use all of that to help leverage all of our own knowledge. So the first one, the first of my core commodities is gold. So the core commodities that I'm going to be talking about today are gold, silver, and oil, because those are the three that I really have the most experience with and the most tradable assets. These options in gold, silver, and oil, they have very liquid ETFs with very liquid options. So they're very accessible to the masses. So that's where I'm going to focus with you guys. There are other commodities such as the grains where, you know, the major focus of the liquidity is going to be in the futures options. That's a great another source of commodity trading. For being able to be applicable to everybody, we're going to focus on the ones that have the ETF. So gold is GLD, silver is SLV, and oil is USO. Just have those in the back of your mind as we go through this. First up is gold. So a lot of people use gold as a hedge for inflation. So when you see this concern that prices globally are going to go up or prices around the country are going to go up, that's that inflation fear. So, you know, bread's getting more expensive, gasoline is getting more expensive, housing is getting more expensive. That should drive gold higher. What have we seen over the last, 10 years, really, since the subprime crisis? We've seen markets, equities, housing prices, everything rally, and gold went up and then came back down. So that inflation fear started to disappear as we switched from quantitative easing, where we were printing money, to quantitative tapering, and we were changing our Fed policy. So gold does trade a lot off of the Fed reserve policy, as well as the Feds of other countries. So the ECB, the European Central Bank, the Bank of Japan, all of these guys, they all have their own policies that always impacts the global bond markets, global currency markets, and gold. Because gold is kind of this nice little beast that can be used as an alternative to a single country currency. A lot of people use the US dollar as a global benchmark for currencies because it's we can always print money and things like that. But the ECB, if you have an issue in Italy, Italy can't print money. The European Central Bank has to print money and impact all of the countries. The United States really only impacts themselves technically. I mean, yes, we impact everybody else in our actions. So when we're seeing a situation where we're printing money, that increases the supply of dollars in the marketplace and reduces the value of the dollar, which means that gold tends to go up when we're doing that. So quantitative easing was all about increasing the amount of US dollars in circulation, and that pressed gold higher because it was an alternative. Okay, so when the dollar goes down, gold normally goes up. That's the first thing that you guys need to make sure you understand. The US dollar has been generally in an uptrend. Recently, and by recently, I mean the last few days, the dollar started to turn lower. Gold hasn't moved much. We got to watch that correlation here and watch what's going on in gold, though, as a result. Okay, so we could be getting something exciting. I mentioned before quantitative easing, that really put a lot of people started to really focus on gold as a result of quantitative easing because you had gold get up to $1,900 an ounce, and people were talking about how much higher this could go. It could explode. It could be worth $25,000 an ounce. You heard that last year on Bitcoin. The same sort of thing happened, except for with gold, it's a much bigger, more liquid market. So the kind of crash that you get in gold isn't the same as the crash you got in Bitcoin, but it still came down a lot. It's sub 1,200 now. That's down about 35% from the highs back about 6 years ago. So what we're dealing with now is what gets gold exciting again? What puts that back in people's portfolios? Because people are always allocating their portfolio to stocks, bonds, and maybe now commodities, especially when you see the kind of action we're getting in the market now. Because bonds and stocks went down together today. So where's your diversification? Are you going to hold the VIX? Or are you going to try to find another asset class that has no correlation or a negative correlation to equities? I'll come back to correlations in a little bit, but I wanted to get that little introduction to you for gold. Silver is very much like gold. So this is number 2 on my list. SLV is very similar to gold, but the price is cheaper. So, gold is $1,200 an ounce, silver around $15 an ounce. So, we're talking about a much cheaper commodity that does also have industrial uses. The result of it having these industrial uses actually puts a correlation between silver and the base metals like copper. So I kind of think of silver as a bridge. When the global economy is growing, we can have both gold and silver go up. You can have both silver and oil go up. You can have silver and copper and everything go up. But, if copper is falling, copper prices are falling because global growth is worse. Generally speaking, we don't always see silver as strong as gold. And that's why right now, I think it's very interesting to look at the gold-silver ratio. So I'll look at that with you right now. Here's the second thing that I want you guys to think about here. So gold being negatively correlated to the US dollar was number 1. Number 2 is look how extremely expensive gold is relative to silver while we're starting to see that global growth come through, say, with oil prices. For those of you that have been watching, oil prices have been rising. What's causing this? Perhaps some of this has to do with China. Okay, now, this is great and all. We can look at this and you can say, oh, well, this is, there's maybe a trade here of long silver, short gold. I'm not going to focus on that right now because frankly, that's not the trade that I necessarily like. You could have said that, a couple months ago and it started to work and then it went right in your face. Or you could have said it right here and it doesn't do anything. You don't necessarily make money trading that gold silver ratio. What you want to know is that when everybody wants precious metals, like during quantitative easing, look what happened to the gold silver ratio. Gold drastically underperformed silver. And then as we got out of it, gold drastically outperformed silver. So if something starts to excite people that they say, I want to put my money into metals and I see some problems with the dollar or something else like that going on, that gets people really excited and that puts silver to the really explosive forefront. So what you want to focus on here is that silver has a very cheap relationship to gold right now, but it may not matter until gold starts to be allocated to portfolios. When people start buying gold, that's when silver can get really exciting and create these massive return profiles. So these trades get much more exciting if and when precious metals get more exciting. All right, we'll come back to that later, or for those of you that look at the courses and everything else, you'll get some more information on this as I think through it. But right now, I just want to point out the gold silver ratio for you guys so you're aware at where we're at historically. And the final core commodity that I'm going to introduce here for you guys is oil. So we've got a lot to talk about here. Obviously, when I talk about gold, silver, and oil all in one thing, that's why we're only going to get a little bit of a scratching the surface here. But, again, if you want to get more depth on this, go to the Core Commodities course. You're going to get much more information there. It's an 8-part course. You got the details when you signed up for the webinar. We'll also send you a follow-up on that after the webinar, along with the replay. All right, so oil. Another proxy for inflation that also tends to trade inversely to the dollar. It's also got a much bigger proxy for industrial expansion. Now think about the amount of space it takes for a barrel of oil. A barrel is large. It's very large. I'm not going to fit many barrels of oil in my office here. That barrel is only about $75 a barrel. Now think about the size of a gold bar. When an ounce is $1,200, that gold bar takes up a lot less space to be stored. Okay. Now, with any physical commodity, there's a storage cost. Oil is a physical commodity. There's a storage cost. So to invest in oil when it gets cheap, you still have to store it somewhere. You got to pay for that storage. That makes it a little bit tougher to use oil as a long-term hedge for inflation. I can put a couple gold bars into my office here, take up almost no space, and have a massive amount of money invested. I don't really have to worry that much about the storage cost of a bar of gold. I'm just worried about the security of it, of course. If I want to put a couple $1,000s into oil, I got to store it somewhere, and I'm going to have to pay somebody for that. So that's one thing that we also have to remember with oil is that there is a storage cost, so it's not as easy to use as a true inflation hedge in the futures market. But if we look at it as in terms of industrial expansion, so when the demand for oil exceeds the supply, we see these oil prices continuing to rise. And that creates this knowledge that oil is being used. What is oil used for? A lot of things. It's not just the gasoline that you put in your car. It's also used for heating homes, plastics, asphalt. Generally speaking, oil has a ton of uses globally for industrial purposes. And that's why it's a big proxy for industrial expansion. When we see oil firm, it means that there's demand. When we see oil weak, like it was a couple years back, it was because the supply was just too much. And that really was driven by OPEC. So we have the situation where OPEC came in and said that they were going to basically let prices go wherever they should go, free market. What'd that do? That drove prices lower because they were just pumping free will. The problem is the United States has a ton of energy companies. We have all these oil companies, and each of them determines their own output levels. We don't have this cartel, such as an OPEC, where they sit there and they say, well, for the entire country of Saudi Arabia, for the entire country of Iraq, Iran, et cetera, this is the amount of oil we get to pump each month. And yeah, they cheat a little bit here and there to try to make a little extra money. But when I've got all these different companies in the United States, it's harder to control the output. So what's going on right now is the United States is producing more oil than Saudi Arabia, Iraq, Iran, Canada, China, et cetera. So all of these countries, and yes, combine these guys, and we start getting the OPEC production, which is more than the United States, and Russian production, which is more than the United States. But the United States is starting to come up here. And this is not a state-controlled output level. It means that the market is naturally shifting towards a free market where supply and demand economics come in handy. Okay? So that's something to just be aware of, because now that actually makes it a better proxy for industrial expansion than before. Before, it could be manipulated by OPEC, where OPEC could just say, I'm not going to pump anymore because we want the prices higher, because that's better for our IPO that we're thinking about doing in the next couple of years. Now, even if they throttle their production or they let it loose, if the industrial expansion is good enough that the United States barrels are required, then they are the important producer. So we as a country are becoming much more important to the oil world. All right, enough about that stuff. I want to talk about why this stuff actually matters in terms of trading, because this is just sort of that introduction of, oh, good, gold has its value, silver has its value, oil has its uses and its value. How do I actually make money with that? Well, if I'm investing, I sit there and look at commodities as a portfolio diversification element. So I have a portfolio of stocks and bonds, and I want something else that's not correlated to stocks or bonds. One of those is commodities. It's not necessary that I need a negative correlation, such as the VIX. The VIX rallies when the market goes down. But if I have at least diversification where they're uncorrelated, then I know that I'm more likely not to see major losses on a day where the market falls. Maybe that doesn't mean that the market falls in gold. Doesn't mean that it's going to rally. It just means that it doesn't have to go anywhere. So what happened today? The market got destroyed. The S&Ps were down about 80. What did gold do? It was up small. So it's not that it has to rally when the market gets hit. It just doesn't have to fall when the market gets hit. I can also tell you that when the subprime crisis started, there was a multi-day period where gold and the market both got crushed. So it doesn't create that natural hedge that people think it does. It creates diversification. These are very different things. So I don't want anybody to go home after this and say to themselves, God, I got to hedge my portfolio. I'm going to go buy gold. It's not a hedge. It's just diversification. You want to hedge inflation, that's fine. If you're looking to hedge equities, that's not okay. So you can hedge for inflation, saying that the prices of the goods that you're going to buy are going to go up. So I want to own gold to hedge my risk of that. That's an okay thing to do. But if I look at this and say, I'm going to hedge my equity exposure by buying gold, I'm making a mistake. Oil is more positively correlated to the markets because, again, that's that industrial expansion issue. So let's look at these correlations. Because one of the questions we always have to ask ourselves is diversification enough of a reason to invest in an asset? Just because butter has no correlation to the U.S. equity market doesn't mean I'm going to go out and buy a bunch of butter futures as a way to hedge or diversify my portfolio. It means nothing to me. the money I put underneath my mattress has no correlation to the market because it never changes in value unless my apartment burns up and then it goes to zero. Just because it has no correlation doesn't mean I need to put it in under my mattress. So let's look at these correlations, and you can see that they change. Okay, so when we came out of the subprime crisis, oil had a very positive correlation to U.S. equities. No surprises there, right? We talked about that before, how it's a sign of industrial expansion and everything else. So when stocks went up, traditionally oil went up. Then we got into that 2014 period where oil got destroyed while the market was going up. Okay, so negatively correlated to U.S. equities as that shift happened, where that massive oversupply in oil, driven by OPEC producing whatever they felt like, pushed oil down, but it didn't push the stock market down. It was just an increase in supply with no real shift in demand. So then we had this negative correlation. And then as that market became more imbalanced, we tended to shift back towards that positive correlation. We had this little thing going at the end of last year where oil was negatively correlated. But this year, I mean, if you look back this year, oil has had a really significant rally for the last 10 months, along with the stock market having a really intense rally over the last 10 months. And again, today, you actually saw oil drop. What pushed oil down? In my view, it was that correlation to equities. People are looking to sell things that signal industrial expansion when the market's getting hit like this. We go to gold and silver. They go basically hand in hand. You can see that gold and silver tend to stay pretty close to each other in correlations. That's the silver line and the orangey gold line. These are the correlations, again, between U.S. equities and that commodity. So gold ranged from having a positive correlation to a negative correlation to a positive correlation to no correlation to a positive correlation to a negative correlation to a positive. You get my point here. Gold doesn't always have a specific correlation to equities. During quantitative easing, it tended to have a little bit more of a positive correlation. Why? Because all assets were rising together. We were printing money. So that was intended to inject cash into the equity markets, but it also meant that cash lost value relative to gold. More recently, negative correlation. So when the market's been rallying, gold's been falling. We've all looked at this. Gold has sucked as an investment for years. It's done nothing. So if I have an asset that is not going to give me any returns, but it does give me diversification, do I still want it? Why wouldn't I be better off just sitting in cash rather than sitting invested in something that's going to range from up 10% to down 10% to up 10% to down 5%, and net over a 3.5 year period, return nothing. Actually, a little negative in gold, a little negative in silver and nothing in gold, especially if it's not going to protect me on a day like today. Or, we look back at U.S. equities here. This is the beginning of the year in January. When the market spiked down, what did gold do? Absolutely nothing. It went sideways. That's not a hedge for my equity portfolio. And that's what I want to drive through here. If it's not going to hedge my portfolio, all it does is create diversification, but without a return. What's the point? Maybe you can make an argument for oil as a strategically timed asset because it had it down 50% from January 1st until the mid-February 2016. So in just over a year, oil prices would have dropped by 50%. This is driven by the futures cost, so that storage cost and everything else, because the way that you would operate this trade via futures would be to buy the front month future, and then that future is always cheaper than the next month. So you continually lose money trying to maintain a position and pay for storage. But since January of 2016, so we're talking all of 16, all of 17, and half of 18, so 2.5 years, this has rallied drastically, and it's almost caught up to where equities were 3.5 years ago. So oil has been a great outperformer, actually, if I started this chart on January 1st, 2016 instead of January 1st, 2015. But it just got into the positive this year, right at the beginning of the year or the end of last year. And you can see that it's up 35% in the year, oil is. So that's a really big run in oil and matches what we're seeing in equity expansion. All right, but again, if the point is, how do I make money on this? It's clear that it's not really in investing. I don't make any money in gold. I don't make any money in silver just by buying and holding. In oil, I finally would have been making money, but it took a long time. Maybe I should try trading it. This is where I come in. I look at these opportunities and I say, well, if oil prices go up and down, they fluctuate. Clearly something around over $100 was getting too expensive, and something around $30 was getting way too cheap. And for a while, we had a range where it went from 40 to 50, back to 40, back to 50. Then we tried 60 to 50, 60 to 50. Then we tried 70 to 60, 70 to 60. And now we're trying 70 to 80. So you got these little chopping ranges. Why not try to take advantage of that money flow? Because the markets move up and down. So if I can catch a bunch of littler trends where these commodities are wiggling, or in gold, let's look back at gold, goes a little down, a little up, a little down, a little up. And if I can catch these moves, I can actually make money instead of not making money. And in that process, I'm still diversifying my portfolio. How am I diversifying my portfolio? By trading a new asset class. So if I'm trading a new asset class, that's diversification, because equities and precious metals and oil don't all trade the same. They trade off of different signals. They trade in different dynamics. They make more exciting opportunities at different times. So if I can find a reliable signal, whether it's technical or correlation driven, to trade these commodities and take the advantage of up and down trends, aren't I better off? Then I'm not just sitting long gold from 1900 down to 1200 and saying, why in God's name am I doing this? Or sitting long gold from 1200 to 1200 over the last 3.5 years and saying, why am I wasting my time? Especially if it's not going to actually make money at the time when my equity portfolio is going to be losing money. So if all I need is a reliable signal, how do I find that signal? Well, I think before I can actually pick the signal, I have to think about the market dynamics here. There's fundamental discretionary money and there is systematic money in these markets. So the fundamental trader, he takes all of that supply and demand information. So with gold, it's kind of more currency-based and bond-based and all that sort of stuff. That's a lot of the fundamentals. Yes, there's jewelry demand. Yes, I said in silver, there's some correlation to copper because of the industrial uses. But we're really focusing on currencies. When I'm looking at oil, there's a lot of information in there. There's production levels of every country and every well and everything else. And then there's the output level from these rigs. There's demand. And all that demand is coming from the end users, as well as the investors, as well as the speculators, as well as the marketplace. And you sit there and say, okay, if I put all these things together and I can come up with something exciting, then I can tell you exactly what price oil should be based upon the fundamentals. Well, I can tell you right now, guys, I was at that CTA for 3.5 years almost. And yeah, the fundamentals generally got the price there eventually. But it might have taken 3, 6, 9 months before the market lined up with the fundamentals. So it's the old saying goes, the market may be able to stay irrational longer than I can remain solvent. So if I'm trading on fundamentals, it may just take me too long to make my money. If I think that oil should fundamentally be $70 when it's trading 40, it doesn't mean it's not going to take a stop down at 30 first. And I can lose a lot of money on the way there. And that's what the systematic trader is doing. He is looking at all of these inputs, all of these numerical inputs, and that can predict price movement somewhat more reliably in the shorter terms traditionally. So I'm not looking for the 9-month move. I'm looking for the couple of day move. Maybe it's a week, maybe it's 2 weeks, maybe it's a month. Maybe it's only a day. So I combine correlations and technical analysis. I can make trades that are shorter term in nature, but higher probability of success. If I'm fundamental, I may get stopped out of my position before it ever gets there. And then I'm just ticked off because eventually I was right, but I'm not in it anymore. That's the thing that really hurts fundamental traders. And that's part of why systematic traders have $320 billion of AUM in the CTA world versus discretionary traders, the fundamental guys, having $40 billion of AUM. So just think about the money now going to the technical and systematic side of this thing. It is 8 times as much as the fundamental guy. So the day-to-day movement of these commodities is driven by computers. So if computers are driving the action, why do I need to spend all that time collecting fundamental data, which requires a lot more data? And I know that I'm going to be right eventually, but it may take me so long that it doesn't even matter. Why not try to figure out ways to utilize this fact, find some of the inputs that they may be using, and jump on these short-term trends where the trend is our friend. So I'm looking for something that gives me a signal of the next day, week, or month's move, not the long-term move. And that's the driver of these markets. Okay, so what moves these markets? Well, there's two things. We said the technicals do, but let's think about where that fundamental guy may step in, because he does matter at some point, because that $40 billion of AUM, he can still move it. Okay, so let's think. Precious metals, a lot of it's investor demand, less so than industrial consumption. Why? Because we're talking about currency pairs and correlations there, and people looking for hedges to a weak US dollar. Yeah, it matters when India and China decide that they're going to buy a bunch of gold for their stockpiles or for jewelry or for whatever else. But the focus seems to be more in gold, on the investor demand. When do people that are building their portfolio start getting excited and say to themselves, I need some gold in my portfolio? How about oil? Oil, the price day to day is very technically driven, but there are a number of fundamental inputs to monitor, frankly. And let's think about a couple of them. The EIA comes out weekly with data that's on supply and demand. It tells you how much oil was consumed and how much oil was produced. There's OPEC meetings. Each time they come out and say they're going to do something and change policy, that moves oil. Every time we get another macro data or input, that moves oil, because people look at all of those pieces of information and try to figure out what that means for the industrial expansion of our global system. Okay? Tons of inputs. Too many inputs for me to use them in my model. For oil, I'd rather just use technical analysis. Too many fundamental inputs, too many things that it can be correlated to, too many things that shift, too many moving pieces. Technical analysis just takes some of the previous price action and then tries to predict the next move based upon the momentum of the market. And it works in oil. Precious metals, I just have to find the currency or currencies that matter the most, whether it's the dollar index, the Chinese yuan, the euro, the rand, the yen. There are all these global currencies. And if I can find one or two or six that help predict the price movement in precious metals, well, that's a heck of a lot better for me. All right. So now we know I'm going to focus my precious metals trading on currencies and my oil on technical analysis. And then I need that one final step, and that's options. So a lot of you guys are probably very familiar with options. Bear with me for just a couple minutes, because I'm going to make this short, but I think it's important for those of you that are not as familiar with options. So first things first, when I'm looking at a long stock risk profile, and so I'm doing this with stock, you could do this with an ETF, you can do this with anything that has options on it. If I have a long stock position that's currently trading $100, and I'm willing to risk $1,000, if this thing goes to 90, I want to get out. Then here's my profit and loss portfolio or profile, right? If the stock goes from $100 to $120, I make $2,000. If the stock goes from 100 to 90, I lose $1,000 and I get out of my position. So it cost me $10,000 to buy that 100 shares of stock, because $100 times 100 shares, 10 grand. And my risk reward profile, maybe I thought this was going to go to 120. I'll make $2,000 if I'm right. And if I'm wrong, I lose $1,000. So 2 to 1. That's very simple. It's just a line, a linear graph, right? Slope of 1. Every time the stock goes up $1, I make $1. What about if it's options? Okay, so if I'm going to compare this to an options position, I need to compare it to the same amount of risk. So I'm willing to risk $1,000. If I can buy the $100 call for $5, that's $5 times the multiplier, which is $500 per contract. 2 contracts, that's $1,000. That's a total risk. That's assuming I'm going to risk 100% of my option premium. So in this case, if my stock doesn't go up, I lose $1,000. But if it goes up to 120, I make 3,000 instead of 2,000. So I'm increasing leverage to the upside. And this is the trade-off, is that window right there. So if I'm think that options are really cheap or that this is a really bullish scenario, I want to be in the options. And if I think that we're going to stay in this kind of area, little chop, I'd rather be long stock. Because you can see that I make money on a move from 100 to 102 in the stock, but my options that I bought for $5 are only worth $2 at 102. So I'm actually losing money there. I don't like that as much. I want to make money when I'm right. But when I see that explosive return profile, I really like it because I can start making more money. And I can use this to leverage my portfolio more. So let's say I know that I'm going to stop out of these calls before they lose all their money. So instead of risking 100% of my premium, I'm only going to risk 50%. Well, now I can double the slope here. All of a sudden at 120, I got 4 of these calls on. And they're worth $8,000 up there. So I've made $6,000. I have cash to play with if I do this with options. I always have cash. And it also means that if I wake up one morning and my stock or my future or whatever is down through my stop and I couldn't get out, I still have skin left over. I have $9,000 in cash. So I'll do this as a stock example. Let's say my stock was $100 and I woke up late today at 2 o'clock and I hadn't set my stop in the market and the stock was trading 85. Well, I lost $15 per share now instead of the 10 I thought I could lose. So I lost $1,500. In my option position, I still only lose $1,000, assuming that these things went to zero. They may not have even gone to zero at that move. So I've capped my risk. I've added leverage. I've created this way to trade around. And when I see that these are overpriced, I can do the opposite. I can have a less leveraged position that profits more on a move from 100 to 102 than a stock position. There are ways to construct all of these different trades, which is what I've spent the last 13 plus years doing now. I was working on ways to construct trades for the scenario that I envision and I'm getting my signal about, because I'm getting signals all the time. So let's talk about what those signals actually do, how they work, how they perform. So in percentage returns, these markets have kind of done nothing. They've chopped. But again, I'm looking for ways to capture the down moves and the up moves and the down moves and the up moves in gold. So what's my reliable signal? Let's give you a reliable signal that worked. One correlation. I'm not going to give you the exact signal, but I'll tell you it was the Japanese yen. So if I built my signal based upon the direction of the yen relative to the dollar, I can create this nice return profile that makes 60% instead of 1% in a year and a half. If I started on January 1st, I still picked up about 40% in a year and 9 months versus, 60% over 3 years and 9 months. So that would have been an even better time to start in theory. That first 20%, never really capture it, but there's a lot of money to be made when you can capture that move from November of 2016 to September of 2017. What was that move? From November of 2016 to September of 2017, it didn't move. It went down, up, down, up, down, up, down, up. The signals work to catch both directional moves. That's the goal here. I add options to this because this is just the idea of I invest my portfolio into gold, either long or short, based upon the signal. Now, if I add options to this, I can get that major leverage, even when the market's not moving in a leveraged fashion. So even if we're talking about a move like this in oil, I can make more money if I'm short oil via puts. Here, I can still make money being long calls, long puts, or using spread positions by taking advantage of that chop in the market. And I can do better than what I get out of just the ETF. If I do it in silver, it's even better. It's 80%. Just gets a little more wild here, right? So we had this major spike in the middle of 2016, kind of in the fall, and then a pull right back. But generally speaking, silver, just the kind of style I like to see. An upward trending return profile. Very nice, very pretty. That's good for returns to have that kind of move rather than that sideways chop we saw in silver for the year. So I'm using the Japanese yen to predict what's going to happen in precious metals. That works pretty well. How about in oil? So I have a proprietary technical signal. It's pretty simple. Uses moving averages. It has a really nice return profile as well. Now, the peak was really January of 2018. So, I'm not cherry picking here and just ending at January of 2018 when this was up 200%. We've had a little bit of a drawdown on that signal, still up about 130% in 3.5 years. Heck of a lot better than having that big 50% drawdown up to this point. Captured much of the up move. And then because of the way that the market's been moving this last 6 to 9 months in oil, it's been a little bit choppier. I've added options to this thing, and I can make more when I'm right and lose less when I'm wrong. That's the nice thing about the option leverage of these markets. So if I can use a moving average in oil to generate returns that are better than the equity market, and I can use a currency signal in gold and silver that gives me returns that are better than the equity market, that gives me the diversification that I want. So if I'm looking for diversification, I want to trade commodities, not invest in commodities. And that's what the Core Commodity Options Trading Program is. So I'm the portfolio manager for the Core Commodity Option Trading Program. I look at gold, silver, and oil. I send out the signal that I'm getting and the trade idea that I have relative to that signal. It shows you guys how to implement one of these signals from a professional that used to work for a hedge fund in commodities and used to trade options on the floor and used to trade as a portfolio manager for futures options and ETF options for years. I can show you some of the secrets that we implement in order to find leverage in the options market when we know with some reliability what the direction is going to be next. So take a look now. I'm not going to give you give you a big hard sales pitch right now. Just go to optionhotline.com/core commodity. That'll give you the introduction to it. You're going to get a follow-up email to this with a webinar and with some more information about the Core Commodity Program, as well as the Core Commodity, the commodity trading stock course. It's an 8-part course, goes into a lot more detail on the trading and implementation and the way that commodities work. You look at all that stuff, and then you can decide for yourself how much value this can add for your trading, because I know you're going to see the value the same way that these numbers start to show you the value relative to an equity portfolio, adding that diversification, and relative to just simply buying and holding gold, silver, and oil. If there are any questions, I'd be happy to answer them right now. And if not, you guys just look for that email offer with all the information and the webinar replay. All right, it looks like I've swamped you all with information. Take a moment to digest it. Take a moment to look at this program once again, and I'll get you the replay in your email tomorrow morning. Thanks again, folks. Have a wonderful rest of your day.